Welcome everyone to my video. This video is about course mind map, corporate finance, a course of executive MBA IPMI International Business School, Jakarta, Indonesia. And we're very glad to have Prof. Sembel as our facilitator, who is an expertise and have experiences more than 25 years in the finance and banking industry. Professor Roy already shared his insight, his experience to us to enrich our knowledge about corporate finance. Okay, let's start to the course mind map. So this is the main mind map of the course. We learn about managing the company. This is an inside to outside perspective. We learn about investment, outside to inside perspective. We learn about ethics, international finance, efficiency market theory, and some special cases. In managing company, we learn about a basic introduction to financial management, then the context, then the investment or capital budgeting. We also learn about the financing, capital structuring, and dividend policy. In the basic, we learn about the definition that financial management is the optimal orchestration of internal and external financial sources toward significant and sustainable value creation. And the goal of the firm, there are basic, operational, social, research objective. What to manage in financial management: capital structure, working capital management, asset structure, then revenue management, cost management, cash flow management, growth management, and risk management. We also learn about the principal and agent problem between management and the shareholders. And we learn about the good governance, which should have transparency, accountability, responsibility, independency, and fairness. And in 4 cornerstone, we learned about the core value principle, the conservation of value principle, expectation treadmill principle, and the best owner principle. We also learned about the 5 value of Ramchara: cash, profit margin, velocity, growth, and customer focus. And in value creation, we learn about the ESG, environmental, social governance, and the triple bottom line of the company. In asset liabilities management, investment mean capital related to capital budgeting. There are 4 methods to analyze about the investment: payback period, net present value, internal rate return, profitability index. And based on these 4 methods, we can analyze whether a proposal investment can be acceptable or reject. And in the financing or capital structure, we learn about the long-term sources of fund, then the source of the financing, whether you use debt or shareholders' equity. And we also learn about the theory Modigliani-Miller, the optimization of tax benefit and cost of financial distress. Next, in the investment, there is theoretical and practical. In the theoretical, we learn about time value of money. It's Rule 72. It's the equation to measure how long it will take to double up your investment. And future value, compounding value, the present value, the future value you discount to the net present value. And in portfolio investment, you learn about the potential, actual, historical, and required return. You also learn about return and the risk, and the total systematic, which cannot be calculated, and a systematic risk which you can calculate it, and you can optimize your return on your investment by learning this systematic and unsystematic risk. And the strategy of investment, correlation or diversification, and the theory of CIIM, capital asset pricing model, and WACC, the cost of capital, weighted average cost of capital. And there is also the technique, the analysis of securities, the method that are fundamental, then technical, and the financial statement analysis. And we'll learn this in the next chapter. And the practical way, we learn about some cases of investment simulation, and also we did on ourselves do the investment simulation in the stock market. And we also do the video presentation of book review. There are 4 books that we should present it in each group. How to Make Money in Stock by O'Neill William, The Uncommon Stock and Uncommon Profits by Philip Fisher, then Random Walk Down Wall Street by Barton G. Malkiel, and The One Up on Wall Street by Peter Lynch. Okay. In analysis of security, part of the investment, we learn about the fundamental analysis. What you should analyze as the fundamental: global and domestic economy, industry analysis, company analysis, intrinsic value of the company, and the market value of the company. In the stock technical analysis of stock market, there are so many famous, popular, well-known technical analysis, and these are some of them: momentum, reversal, then trend up, trend down, moving average, support, resistance, Fibonacci treatment, then triangle, double bottom and top. And the financial statement analysis is to analyze the company performance, the management, whether it's efficiency or not. What about the return and the profitability, liquidity, activity? This tell us the efficiency of the management, leverage, how much the company finance their asset or their operation using debt, and then the market ratio. How about your stock performance in the market, and the natural level and the quality of ratio? The ratio is not only about a number, it tells us about the quality of the company performance. The historical trend, how is the last 5 years, and what's the predict of the forecast for the next 5 years. And you can compare the company performance to the industry benchmark. And then the last is the two-prong analysis. Next, we learned about the ethics. Whether greed is good, it depends on the definition of greed. If greed in the context to make the company conduct better governance, then it is good. But if the greed is the conflict of interest of the staff who wants to get money in unethical or illegal ways, then that is not good. In this chapter, we also learn about the fraud risk management, the 7 shenanigans theory, the occupational fraud and abuse, the type of the corruption, asset misappropriations, fraudulent statements, the fraud triangle between perceived pressure and the correlation between the 3 of them, perceived opportunity and rationalization. And the fraud reason, usually why do people do the fraud? Because of the huge personal debt or loss, or lifestyle beyond incomes, or in Indonesian it says that besar pasak daripada tiang. Then the over speculations, you did the wrong investment or because of your over speculations. And fraud can be reduced by giving them the incentives, a physical, monetary, social, and moral incentive. The next, we learn about the international finance. There are theoretical, and these are the practical using movie review. In the theoretical, we learn about the foreign exchange market, currency future and options market, and arbitrage versus speculation, big picture of exchange rates, and the comparison of the IRP, triple P, and IFE theories. And in the practical, we should make a movie review. There are rich traders about the Barings Bank collapse, and other people's money about the M&A, merger and acquisition, and Wall Street too about the subprime mortgage, which leads to the financial crisis in 2008. In the movie Rich Trader, it tells us about the Barings Bank's collapse because of the fraud that were made by one of the staff in CIIMX, Singapore Market Exchange. And it tells us about how arbitrage turned into speculations and the causes of the failure and the risk management. In the other people's money, we learn about the merger and acquisitions, type of M&A, and the basic process of M&A. And in the Wall Street too, we learn about the subprime mortgage, how the prime mortgage turned to the subprime mortgage, and how is the process of the asset-backed securities. Next, we learn about the efficiency market theory. Uh, uh, this is always the practical way, and this is always the theoretical. So, what's the efficiency market theory? And the form of the market theory, efficient market, the perfect of capital markets, anomaly, the anomaly against efficient market, and the strategy in an efficient market. Then there is in class experiments, it's tell us about the representative heuristic, how we did a bias analysis due to the rule of thumb. And the second, you irrational versus irrational, it tells us about how people often do or decide something irrationally, but they think that the decision was rational. It implies to the investment and the securities too. And the last is we learn about some special cases about investment fraud, then corporate restructuring, and event analysis. And investment fraud, it tells us how to analyze whether an investment or an offer is fraud or not. So you should analyze the company, the owner, the contract, the legality of the company, then the product and the transaction mechanism, and last, about the profit. Is it too good to be true or not? And if it's too good to be true, then it's kind of early warning for you to more deep dive to this investment. And in corporate restructuring, we learn about the restructuring, what should be restructured, and the surviving, transforming, and business, the stages from the stop the bleeding, financial restructuring, strategic realigning, redefining core business, and new ways of doing business. This case was based on Prof. Roy experience. And the LBO case leveraged buyout case at GR Nabisco. In event analysis, there is IPO, M&A, and bond issuance. Yeah, that is all we learned in this course. I hope this can help you to get a helicopter view of the corporate finance. Thank you.